Hi everyone, welcome to the first of the monthly updates for Westferry for 2026. So the last one of these we did was December last year, and since then we've had two monthly reports out, and I'll just uh, share my screen to quickly run through those. So in December last year, we had a really good finish to the calendar year. And you'll see there on the screen that we managed to produce a 2.4% gain in December, which outperformed the market, and finished up with a bit over 15% return for the 6 months to December for the fund. So our best period in quite a while. We've benefited largely from continued good performance in the latter part of 2026 from AF Legal Group, coming off the back of the well-received first quarter update. And one of our big winners for the year continued to perform Verbrek, which is a engineering services company based here in Brisbane, actually. And we've still got a solid position in Verbrek. The January report was out last week, and you'll see there that we managed to produce another positive month, up 0.5%, in what was a pretty bizarre month in terms of market movements. And I'll just comment a bit about that at the moment because it's continued very much into February. So you'll see the small ordinaries index there. So firstly, the small ordinaries index is not quite what it says on the tin. It's basically the ASX 300 index with companies 1 to 100 removed. So essentially companies 101 through to 300. They're still pretty big companies. So it's not really a comparison to the type of companies we're in, but it nonetheless is closer, I suppose, than the ASX 200 because it's less or not affected at all by the big banks and mining companies that tend to dominate the ASX 200. In one point in January, that small ordinaries index was up a massive amount. I think it was up 7-8%, but had a very sharp fall in the last few days of the month, and that continued into this month. So if you look actually from January 28th through to February 6th, so just 6 trading days, the small ordinaries fell almost 11%. And it then had a bounce, but today we've seen again a huge divergence between the small ordinaries and the main index. So the small ordinaries today is down 1.8%, whereas the S&P 200 is up 0.3%. And today was a summary, really, or further evidence of what's been happening the last few weeks. So today, although exacerbated today and recently by the fact that CBA and now today ANZ put out really good results, to be frank. In ANZ, there was a remarkable cost cutting, which has been taken place by their new CEO. Often that stuff sort of is big in the media, and you see that a new CEO will claim that they're going to cut back and be disciplined on costs. It appears that he really has been ruthless, and the market was very happy with the increased profit from ANZ today. So that, along with continued strong commodities performance, driving growth in BHP and Rio, the market loved the fact that Rio gave up on a proposed merger with Glencore at one stage. All the big companies, basically, except for CSL, which has had its issues, have performed extremely strongly and driven that S&P 200. Conversely, the small ordinaries index, which has had a remarkably successful 12 to 18 months up until mid-January this year, has been driven by momentum companies, or what you might call quality at any price companies. So there I'm talking about the likes of Pro Medicus, Lavisa, Hub 24, Zero, Life 360. stocks that are undoubtedly very, very good companies, but which have been bid up to trade on insane earnings multiples. Um, and that, together with a bunch of software stocks, have driven that index. But what we've seen in the last couple of months, but heavily driven in the last couple of weeks, is a real loss of confidence in those stocks, which is starting to become a bit contagious. And the main cause of that seems to be uh, a massive amount of news flow coming from AI, um, generative AI companies. Obviously the likes of OpenAI with ChatGPT and Claude and some of these other um, uh, you know, heavily funded AI companies are producing pretty much daily new products, new agents, as they're called, new add-ons that are causing the market to have a panic uh, in relation to some new sector of the market pretty much daily that AI is going to take over that particular area. An example is 2 days ago, we've got two large insurance brokers listed on the ASX. They were both down by 10% at one point during the day on the back of a uh, I suppose, I don't know what you call it, an agent, a new add-on to one of the AI companies, which purported to, um, well, essentially do what um, some of our compare the market type companies do here. Others would say it was more advanced than that. And I suppose even if it wasn't advanced, more advanced than that, the issue is that the market is deciding that it's only a matter of time before it does become sufficiently advanced that it starts to threaten the ability of those companies, even in very embedded positions like realestate.com.au. Um, Basically, anything which previously seemed to have an unassailable moat is now seemingly under threat. And even if it's not, the fact that some of these companies is copying such a hiding means that some of the fund managers that have done really well out of that for the last year, I think, are tending to sell off other parts of their portfolio as well to prop things up. So it starts to become contagious within that type part of the market. The good news for us is that we've never played in that part of the market. I don't have a particular style, but I'm certainly more of a value investor than I am a momentum investor, meaning that you know I am legitimately scared off by anything that trades on an extremely high multiple. Sometimes there's excuses if a company's of such high quality that it can be justified, but um, it's rare that I will have anything to do with those companies just because I feel that it's hard to maintain confidence even on the back of any sort of bad news. There's no It's a long way to fall, I suppose, when things go bad, and which is starting to prove the case. You know, conversely, they would say that I also missed out on a lot of the big gains to be had over the last 12 months. But the nature of my fund is that I'm inviting people to invest alongside me. All my own money is in it. I tend to perhaps be more conservative than I should, than would be the case with a fund manager who was chasing results without the concerns that arise from having all of your own money uh, in it. So that's sort of where we've landed. As I say, I think we're slightly down for this month so far, but we're not going too badly compared to the small orders, which is down about 4%, and was down 8% at one stage during this month. Um, so we'll keep an eye on that. Normally, such large falls might give rise to opportunities, and I am certainly keeping an eye out for things that are thrown out as part of this mess. As a general comment, I would say that despite the massive falls in some of the prices of these companies, they still are not sufficiently cheap for us to get involved with. You look at looking at the list of all the stocks that have been smashed in recent times. A lot of them just deserve to be. But you look at a company like Hub24, which I think is a great company and is down massively from its highs, but it's just still too expensive. It's still trading on a huge multiple of its earnings, and to justify buying it, you still have to uh, take a view that it's going to grow far more quickly than I think it will in the future. Notwithstanding, it is an excellent company, but we'll keep an eye on those things and look for opportunities. Jumping back to the January results, and just before I jump into that, remember that a lot of the purpose of these monthly reports is A, to put them up on the website, but also for those that do join to throw any questions you have at me. So use the Q&A function or the chat function, um, and I'll try and answer those at the end. On the January results, we had a really good result from Mitchell Services. Mitchell Services again is a well, not again. It's an unusual company in that it's not one where you would buy it and forget it. It's not a high quality company. It's a drilling. It owns drills and it deploys them along with manpower in mines, predominantly coal mines, but they have done a good job at diversifying that over time into gold and some of the other commodities that are doing a bit better than coal. Um, it's a great stock to move in and out of over time. They've had a history of messing things up, having some disputes here and there. They're badly affected by weather. We started to take a position in them about 6 months ago, partly because of the weather. It seemed, and they're very Queensland based, and it was apparent that we'd had 3 to 6 months at that stage without particular dramas or floods or ongoing wet weather, which is also a reason we took a small position in Coastal Entertainment, which owns Dreamworld, although we're out of that now. And both Dreamworld and this company, that weather thematic did play out. With a bit of smooth sailing, the operational leverage in a company like this from just having a few extra days a quarter of pure good weather where they can earn those extra few days of revenue against a fairly flat cost base means that they can make money. And they've managed to continue that throughout the the um, the quarter to December. So often that can be a bit shaky because things close down around December. But when they reported in January, I and the market were pleasantly surprised that they managed to continue that through the slow period. So you'll see that it is one of our larger equity positions, although it is only a 2% position in terms of the whole fund. We have sold down a bit as it's strengthened again into February. So as I say, it's not one where we want to hold it forever at any price, but on that thematic and following those sort of things, it has done really well. You'll see that it was quite unusually one of our, we've only got 5 or 6 foreign holdings, mostly New Zealand, has cropped up. Green Cross is not and has nothing to do with the Green Cross that's the Australian vet practice. That's, I think, going to be listed again on the ASX from what we hear. It's a company that owns pharmacies and primary health, so GP clinics throughout New Zealand. We've been invested in it for quite some time and have done really well out of it. It's quite a boring company, which has made it quite unusual why they had good results when they reported in December. Their year runs through till 30 September, but when they reported in December, there was good results. But it seems the market took a little while to get their head around that, and it's really taken off in January and has continued to go sharply up in February. So even though it's a fairly small holding for us, less than 1% of the fund, it did so well in January that it was able to become one of our largest contributors. In terms of the tractors, Fiducian Group is a tough one, and it's continued to struggle this month. It's a company that I think is really well run. people with skin in the game, has an incredibly good, loyal customer base. They essentially are financial planners, but that also provide their own product, essentially providing fund-to-fund products that are sold to their customers. Um, That's to say they've had a really long history of steady, profitable growth. Their owners are very sensible when it comes to capital management and thinking about things like operational leverage and how they reward shareholders and what needs to be reinvested in the company. So we've been in and out of it for a very long time and done well. And indeed, even this time we did well initially. Um, what has happened with them in terms of the pullback? They're a very liquid stock, so they can tend to move around sharply for no particular reason. There may be an element of the AI fears that I've said before, which have mostly affected software, but and other tech sort of positions. But there might be an argument that AI can start um, uh, getting into the area of financial advice and even funds management and this kind of thing. So that may be there may be some fears there. Um, as I say, the their client base tend to be very loyal, elderly people. I mean, there's certainly AI will affect that over time, but I think it will be sufficiently slow that the industry will be able to adapt. And I do, along with some areas in law, I think that financial advice and financial planning requires such a human trust, human element that it will be one of the slower areas to be affected. Um, Ultimately, Fiducian has the other issue that it's under ASIC investigation, which should, ring alarm bells. Um, but in this case, I don't think it's a concern. It's that they're being sued by ASIC in relation to one fund they put out, which purported to be a ESG fund, so essentially an environmental, social, and governance focused fund that didn't meet certain requirements. It's a concept called greenwashing. Basically, the argument is that you're trying to raise money on a green type product when it's not in fact green because it owns certain things. I've gone into depth in terms of what's being alleged there, in terms of what sort of the outcome might be by reading through some of the previous cases ASIC have brought in those situations. I'm confident it's very much a one-off for this company. It's not a sign of some bigger problem. And secondly, I'm confident that look, I think they probably will get fined for it, and it'll be a solid fine. Might be in the millions, might be $2 to $8 million. They might just have to cop it. But they've got 25 million, maybe more now in spare cash. They can afford to deal with that, and it's it's at what I think is a really good price at the moment. Look, um, AMP reported today, and there was some disappointment around. It seems a lot of things with them, but one aspect was perhaps the pressure on the margins that they've been able to apply to some of their funds management business, and maybe that has also been causing some negative thoughts around Fiducian today. Um, but look, it's one of those stocks that does move up and down for no particular reason. I think there's a good chance that the sort of prices it's at the moment will prove to be quite cheap as it continues the sort of momentum it's managed over well over a decade or more now. Um, so that's um, where we've got to in January. Just looking through some other we do have a portfolio that um, probably isn't the best setup for a rising Australian dollar, I have to acknowledge. And so that's um, probably affected us a little bit. We did well last month with our position in Hello World, which is one of the stocks that will benefit from a rising Australian dollar. Um, where perhaps we are most hit by it is with our holding in CXZ, our second largest position, which earns its revenue in US dollars. But look, I'm not, as someone who is taking a very long-term view and is managing my and your money over a period of hopefully decades, we're not massively focused on trying to pick short-term variations in um, foreign exchange. Um, so that is a bit of a headwind for us at the moment, but it's nothing when looking at the larger movements that the market's putting out there at the moment, at which, as I say, we've largely managed to avoid the worst of because of our investment style. So look, I'm feeling very good about our portfolio at the moment. It's the most liquid it has ever been, um, certainly for many years. Well over around 70 to 75% of our fund is in shares, cash, or in other managed funds, which can be liquefied very quickly. Our two large unlisted positions continue to go really well, and I'll spend some of the upcoming monthly reports speaking to them. So you'll be aware of Allmain. We've heard from the CEO of Allmain previously, which continues to be profitable despite us continuing to bounce along the bottom when it comes to defaults and bank repossessions, which drive some of its business. And then with Red Whale, our swim school business, and I will have the CEO. I see Mike is actually on the call now, the CEO of Red Whale, which is very good of him to join. He has kindly offered to speak to us all in one of the upcoming monthly um, reports or video calls, and we might actually try and get. So Michael's based in Switzerland and runs the Swiss part of the business, and there's also a general manager for the UK part of the business, and we might be able to hear from him as well. So both really impressive guys, and I'm very happy with our position in Red Whale. But yes, more on that as we get through the year. So look, I'll look forward to joining you next month. The rest of this month is focused on half-yearly reporting for most of our companies, so there'll be plenty to say. But yeah, unless there's any questions at the moment, I'll leave it there. Sorry, I'm just looking at. Yeah, sorry, Mike's mentioned. Thanks, Mike, for your question about the size of Westferry. No, I'm very happy to share that. It's 23.4 million at the end of January. So it's been fairly stable for quite a number of years. So just going back when we first started Westferry, which was bought out of 300 Capital, a company structure which started with 400,000 back in 2016. We started Westferry in 2021, at the very start of 2021 with 8 million, and then it rose very quickly to 20, probably quicker than was healthy in hindsight. But certainly it's hovered around 20 to 21 for a number of years. It has gone up to 23.4 at the end of last month on the basis of a good 6-month performance and a little bit more money coming in. Yeah, the aim for us is to look. I've always said I'm not particularly interested in growing funds, certainly not for the sake of growing funds under management. There's some benefits in it in terms of us being able to have outsized influence when we're talking to some board and management. But it's the type of fund that I would like to grow steadily, if at all. But my focus is certainly on performance rather than trying to take more money in for the sake of it. If that performance one day leads it to grow to a certain size, I'll certainly that's then becoming problematic in terms of us being able to allocate or deploy money. I'll put a stop to it because, as I say, all my own money's in the funds, and I don't want to put a cap on my own returns. I don't think that's a problem until we hit 50 million. And then I'd start to have a think about it. But we'll worry about that if it ever happens. Yeah, I mean, the performance is the absolute focus. The distributions each year also tend to bring it back. Probably 60% of our distributions are reinvested, but around 40% of people take them in cash. So, and the last couple of years, actually, we've had some large distributions. So I think we had over 9 cents distribution last year on the back of um, the sale of one of our unlisted positions. But yes, in terms of the structure, it's the simplest it's been in terms of us just having two large unlisted positions, a couple of tiny ones, but only two main ones, which makes us a bit easier to explain. And the um, other main area that's not listed is in um, other managed funds where I think I have some value to add by identifying good up and coming fund managers. Um, so, it's not a case of us just putting money with other people that, you'd be able to access yourself. Or maybe you would, Mike, because you're all over this area, but, a lot of my other investors have no sort of ability to know who they might invest with. Mike, good question also. Thank you in relation to Kit McGrath. Um, so yeah, Kit McGrath, we had a large position at one stage, and did reasonably well last year, and then have sold down our position to some extent. So our position is probably half what it was 6 to 8 months ago. Just because I think it is a business that has a limited future. I think it's now a really well run, and I support the management changes that have occurred there. Um, it's like a lot of businesses, always going to have this target on it that AI could supplant it. I actually have strong views on that. That I think AI will be very slow to supplant tutoring, certainly of primary school age kids, which is their bread and butter. I really, having experienced it and being, through some of that myself, I think the personal touch of tutoring is incredibly important and is what parents are paying for more than the content. Um, in addition to being able to offload their kids for an hour, which you can't do with AI necessarily. But that aside, it's probably a business that struggles to grow at the current price. I mean, another reason I've liked the business is because over time, the market, I think, has struggled to understand the fact that the cash flow is better than the headline profit. Certainly now that the former CEO is gone and the capex has been wound back, so capex is less significantly than depreciation. So the headline NPAT is often undersells what they're actually producing in terms of free cash flow. So I think they do pump out 4 million in free cash flow at least on a yearly basis now, and I think that is sustainable. Where there's some parts of the business that might fall away, there's some levers they can pull to offset that in terms of just this things like a lot of the business, especially in the UK, are still on a cash basis. So just transferring that to electronic payments and whatnot, I think will capture some leakage. Uh, and there's some reasonable things that will offset some of any sliding growth. So at a certain price, up to at 50 cents, I think it's well valued. At 60 cents, we were selling a bit. At 40 cents, I think it's cheap. Um, does it get sold? Maybe. I mean, there has been some moves in that space. I don't know necessarily what the end game is. Certainly, I don't ever invest in things hoping or expecting a sale. Like I treat that, I don't know, it's like drawing a blackjack. it's a nice bonus when it happens, but you otherwise are trying to invest in something um, that you don't expect for that to happen. We're invested in it because we think it can produce a nice sustainable cash flow at a really high yield, and that there's a really good capital allocator in there who will ensure that that comes back to investors in an appropriate way through buybacks or through distributions. So in that regard, it's not sexy or interesting at all. It's not going to double, but it's going to pump out a nice yield for us, I think. And it moves around a bit and allows us to trade it a bit as well. As I say, it can move 10 to 15 cents over the course of a period that allows us to buy and sell because there's a reasonably precise valuation I think you can put on it. Excellent. All right. Well, thank you very much to everyone. And Mike, thanks for your questions. Really appreciate those. I'll get this posted to the website. And yes, I'll give you some notice of the upcoming uh, video calls where we'll get some of our unlisted CEOs along in probably in April and May. Thanks very much, everyone.